There's obviously a lot going on in the world right now, but we are going to look at 6 key catalysts that could unleash the next wave of inflation, as if you didn't already have enough to worry about. In this video, we're gonna look at all 6 of those, and I'm gonna show you why the last one is actually a root cause. It's a driver of the other inflation catalysts. If you don't know who I am, my name is Joe Brown. I am a former stockbroker. I spent years advising the top 1% on how to manage their wealth, and after I made enough money to leave that world behind, I turned my attention to teaching regular people financial strategies that exist outside the mainstream, things you'd never hear from your traditional stockbroker or financial advisor. First up on our list, catalyst number 1 is China's recent stimulus package that caused the biggest single-day rally in China's stock markets since 2008. It's no secret that China's economy has been struggling recently, and in a recent effort to try and lift their economy, they unleashed a massive bomb of stimulus on their nation. This stimulus includes rate cuts, as well as tools to shore up their capital market. One of them is a swap program that allows funds, insurers, and brokers easier access to funding in order to buy stocks. This is a little bit different than the stimulus you might be used to, where they're handing out checks to people to help them buy groceries or giving money to companies in order to help keep people's jobs. No, this stimulus is directly intended to boost their stock market, but not just their stock market, because their property markets are even more important. And that's why they're instructing their banks to lower mortgage rates for existing home loans before the end of October. Not cutting rates on new home loans, that's cutting rates on existing home loans. Needless to say, this is a monster stimulus package, and at least for asset prices, it is starting to work. In other words, starting to cause inflation. But as you know, I'm not a fan of top-down command and control economies. There's always going to be unexpected side effects, and one of them is that this stimulus has added $130 billion to the coffers of China's rich, which is pretty typical when you have financial engineering, that there are winners and losers, and usually the winners are the well-connected. But it's not all winners, as we also have a short squeeze taking place that's starting to crush some of the hedge funds in China. The short squeeze has caused Chinese stocks like Alibaba to rally immensely over the past couple of weeks, as Alibaba is itself up about 33% in just a few trading days. For those who aren't aware, I run a coaching program called Heresy Financial University, and one of the things I do beyond just teaching you how to invest is sending out periodic alerts whenever there's an opportunity forming in the market that offers potential asymmetric returns. Alibaba is one of those plays that I recently sent out a buy alert for at the price of $75 per share. Alibaba is now trading at $112 per share. If you'd like to sign up for alerts like that, join Heresy Financial University. The link is in the description below. The second catalyst that could bring inflation roaring back is war. It's been dominating the headlines recently, so it should come as no surprise, but the war in the Middle East is quickly escalating. We've got Israeli airstrikes, we've got Iranian missiles coming into Israel, we've got Hamas, we've got Hezbollah, we've got Lebanon. Everybody in the Middle East, it seems, is currently escalating things, and it doesn't look like it's slowing down anytime soon. And I'm not going to comment on the war other than by saying war is nothing to be celebrated. With Israeli airstrikes and Iranian missiles and Hezbollah and Hamas, seems the conflict is doing nothing but escalating. I'm not going to comment on the war in the Middle East other than by saying what I hope is obvious, that war is bad, it is nothing to be celebrated, and I hope it ends as soon as possible, because while there may be some bad people dying, there are certainly a lot of innocent people dying as well. So I hope resolution and an end to this conflict happens as soon as possible. In terms of war's effect on inflation, all else being equal, war drives prices higher. Number one, you have materials that are being used specifically for destruction. You have energy, you have metal, you have lead, you have steel, you have all the things that people need for tools of war that are literally being destroyed. They're being blown up, they're being shot, they're being destroyed. That drives prices higher, because all of those materials and all that energy are being driven toward the war effort for destruction rather than being used for productive purposes. Number two, all of the property that gets destroyed as well has to be rebuilt. Therefore, there's more labor, more money, more capital, more materials that have to be used for rebuilding as well. And these effects can be quite pronounced as well. I'm sure you remember when Russia invaded Ukraine, energy prices skyrocketed around the world, not just because of that, but that was definitely an influence. And if you're curious how markets perform from geopolitical events that have to do with war. Take a look at this chart from LPL Financial that highlights things from Pearl Harbor to JFK to the Russia-Ukraine war and September 11th. And you can see that Pearl Harbor was the longest drawdown in the market by far at 143 days until it reached a bottom. Iraq's invasion of Kuwait was also an outlier at 71 days. And outside of those outliers, the days to the market bottom are usually within just a couple of weeks. The total drawdown tends to be quite muted as well. Now, it's always possible this thing continues to escalate, drags the United States in, becomes like a World War III. So we could take a look at what happened to inflation during World War II as a rough estimate for what we could expect as a baseline. The reason why I'm going all the way back to World War II is because there are a lot of other correlations that we have right now between the 1940s and today in terms of the United States government's debt to GDP, fiscal policy, monetary policy, and we won't get into that. I made plenty of videos about that in the past. You can go and look those up. But if we want to see what happened to inflation during World War II, we can see that from about 1939 until about 1949, we had quite a few years with above average inflation. Inflation spikes as the cost of the war drove prices of everything much higher, which means if history is any guide here, you should be expecting a couple of weeks of underperformance in markets, of asset prices selling off. And that would be something you might want to take advantage of, but not bet on it completely crushing and collapsing US markets, because historically it usually doesn't. And in fact, more often than not, the one-year performance of the stock market after the beginning of a geopolitical event, like some type of war, is usually positive. So take that for what it's worth. In other words, asset price inflation. Price of oil has risen 3% just on the news of Iran launching missiles at Israel, and it is up about 6% from its bottom overall over the last few trading days. Now, most people are completely unaware of how vital cheap oil is for literally everything in life. I challenge you to take a look around the room that you're sitting in right now and find something that isn't made as a byproduct of oil or transported to you using oil. You probably just won't be able to do this. Whether it's something made with plastic, whether it's an electronic device, whether it's food that is grown and harvested by machines running on oil products, whether it's clothing that's been shipped to you from overseas on a boat that runs on oil. Oil is literally the foundation of the modern world. It is the economy. Cheaper the energy, the more abundant life is. The more expensive and more scarce energy is, the more expensive and more scarce everything else in life is. There's a fantastic book I recommend called Energy and Civilization by Vaclav Smil that shows how basically all of human progress and innovation and advancement and growth is driven by energy. So needless to say, more expensive oil and energy means more expensive everything else. Okay, the fourth catalyst that could unleash the next wave of inflation, or at least contribute to it, is the strikes of all the port workers right now. We have a massive port strike beginning across America's East Coast, and it is now choking off the flow of a lot of America's imports and exports. Now, if you're not aware, the United States has a structural trade deficit. And that means for decades, we import far more from other countries than we export to all other countries. There are still a few things that we export more of than we import from other countries. That would be things like food and US dollars. But almost everything else that you use and buy on a daily basis, we get that from overseas, which means that these strikes by these port workers are actually a big deal. The White House is currently not doing anything in order to cool this down. In fact, it seems like they're actively encouraging the strikes, hoping that these workers win and get better pay, which is what they're asking for. Now, they're asking for a lot, considering that about 1/3 of port workers make over $200,000 per year. Now, don't get me wrong. They work extremely hard, and a lot of that pay comes from overtime, which means they're working a lot of hours as well. But that also means that in a completely free market, this strike would not work. There would be people lined up for miles waiting to take those high-paying jobs. The only reason they're not hiring anybody else right now to take the place of those people on strike is because it's against the law. So even if these strikes get resolved quickly, that will likely just mean it is more expensive to import stuff because somebody has to foot the bill for the higher pay for all the ports. And if it doesn't get resolved quickly, the shortages that will be experienced very, very soon as a result of nothing coming in will mean obviously a very quick but intense spike in prices. By the way, if you are looking for somebody to walk you through exactly what comes next for America and what to do about it in your portfolio, then subscribe to my free newsletter. I call it Letters from a Heretic. It's the only place where I'm going to do deeper dives on some of these topics that I seriously doubt you're going to hear about anywhere else. As soon as you sign up, you're going to start getting my 5-day series called The Most Dangerous Ideas in America. These are ideas so powerful that could change the economic landscape that we live in. I'm going to send you my write-ups on things like why we could be on the cusp of World War III, the rise of the House of Saud, the true location of the digital financial all-seeing eye, a secret manuscript that predicted the end of America and what that means for your wealth. I'm going to email you about America's coming dark summer and even the final phase of the US dollar. So if you're interested in receiving that so that you can make better decisions about how to grow your wealth and protect it during times of crisis, click the link in the description below, enter your email, and I'll start sharing with you everything I know. Catalyst number 5 that will contribute to the next wave of inflation is the Federal Reserve itself. Federal Reserve recently lowered rates and the market is expecting some massive rate cuts from them going forward, to the point where Powell had to come out and say that the Fed is not in a hurry and they're going to be lowering rates over time. All else being equal, lower interest rates make it easier to borrow and spend. And because all borrowing is loaning dollars into existence, that means the money supply goes up, which means there's more money chasing the same amount of goods and services, which drives prices higher. For about a year and a half, they were trying to cause the money supply to fall, but they gave up on that in about August of 2023, and the money supply has been rising ever since. See this 1-year chart of the money supply that even before the Federal Reserve started lowering rates, the money supply has been on the rise for about a year now. And it's not just the Federal Reserve, it is central banks around the world. If you take a look at the money supply of the 4 major central banks around the world, you can see that recently we hit a new all-time high. This is also contributing to the slowing down of the balance sheet runoff, as their quantitative tightening will likely be coming to an end very soon here. Essentially, monetary policy is becoming more and more easy. This is a fuel to the fire of inflation, as they have all but abandoned the fight against it. And you might be wondering why. If inflation is not down to their target yet, which they keep on saying is 2%, and we're not there yet, why in the world would the Federal Reserve be abandoning its fight so easy? And the answer is because their job is to make sure the government doesn't default. And if the Fed keeps on fighting inflation like they were, the government would default. And this is where we get to the 6th catalyst, which is the root cause of everything that we're looking at right now, which is the deficits. In 2023, the federal deficit was $1.78 trillion. That is the difference between the money they took in taxes and the money they spent. They spent an extra $1.78 trillion beyond what they took from us in taxes, which meant that's how much they had to borrow. But that was 2023. This year, year to date, so far in 2024, the deficit is already $1.89 trillion, which is up 24% compared to the same date last year. Just to be clear, we're not talking about the national debt. We're talking about the deficit. That's every year how much they're adding to the debt, how much they have to borrow just to keep paying the bills. There are many words to describe this, what is happening right now. Lunacy, incompetence, maybe even malevolence, but I'm gonna go with the word that the Congressional Budget Office itself chose to describe this situation, and that is unsustainable. This path that we're on is an exponential growth path, one in which the national debt doubles roughly every 10 years. Currently, the debt is at $35 trillion, and within the next 9 years, that means we are set to hit $64 trillion. And by 2073, 1 quadrillion. You can find this report on cbo.gov, where the Congressional Budget Office said that the federal debt held by the public is projected to climb to 202% in 2051, and that a perpetually rising debt to GDP ratio is unsustainable because financing these deficits and servicing the debt would consume an ever-growing proportion of the nation's income. Essentially, the only way out is printing. Hence why the Federal Reserve is lowering rates so that more and more money can be lent into existence, making its way into the government's hands through borrowing, and they can have what's called a inflationary deleveraging. This is exactly what they did after World War II when the debt to GDP ratio hit at 120%. And it is likely what they are planning to do now that the debt to GDP ratio is 120% again. There's not enough money to continue going at the pace that they're going, spending at the pace they're spending, increasing that spending at the rate they're increasing it by without printing more money in order to do that. This drives the price of everything higher, allowing them to pay back dollars that are worth less than what they originally borrowed. Yes, the national debt will go up. Yes, interest rates will go up. Yes, inflation will go up, but it will put the government in a better spot because they will offload the pain or the cost, the real cost of that debt onto the economy. And we all pay for it through inflation. And while everything we talked about in this video are the 6 largest catalysts right now that could unleash the next wave of inflation, they are not the only ones. So don't get caught on the wrong side of this. Remember, savers are lenders, and in an inflationary environment, lenders get screwed. Buy scarce assets. And if you'd like me to help you apply ideas like this to your investing, click on the link in the description below. As always, thanks so much for watching. Have a great day.